So how to make money in shares, buying shares of companies, if you are a retail investor and you are new into this business of investing in shares and you are losing money, this video it's for you. It might help you. And also, if you are interested in investing into shares, but you don't understand on how to make money in this thing, how does it work, this video is also for you. So the easiest way of making money when buying shares of companies, it's buying low and selling high. You don't want to do the opposite of buying high and then selling low. You're going to lose money. You have to buy the shares when they are at their lowest, when they are crushed. And then you must sell them when they recover, and then now they are at their highest points in terms of trading. So you then sell them. So I'm gonna use two examples of my positions, the stocks that I bought or the shares that I bought, shares of companies that I bought previously, where I was buying low and then I'm not yet selling. I haven't sold any of those shares. I'm still holding, I'm still in profit. So I'm gonna use two examples to show you this basic concept of buying low and then selling high in order for you to make money when investing into shares. So the first example is Ivanhoe Mines, which is a mining company. And on my previous video, I talked about this mining company. I was sharing my position that I'm buying this company, I'm buying the shares of this company rather, at a price level of around 10 Canadian dollar and 80 cents. And now the share price is up. It's trading around 15 Canadian dollar. And without wasting any time, just take a look at this clip from the video that I made on my previous video about Ivanhoe. And then I will see you on the other side when I will be now diving deep into details of buying low and selling high. See you on the other side. So the stock is on a pullback. As you can see, this sharp decline all the way to the support level around the 10 Canadian dollar a share. This was caused by operation disruptions, which were caused by a seismic event. And of course, people had to be stopped for going underground because there was a tremor or an earthquake underground, which affected underground working places and caused some flooding. Currently, the company is busy rehabilitating all the affected areas underground and also pumping water out. That's the reason why the stock corrected sharply. This is an opportunity for you as an investor to buy this company because I believe Ivanhoe Mine is one of the quality mining company with great assets. They have copper assets in DRC, Congo, and also nickel assets. Then they have PGM assets here in South Africa. So when it comes to this concept of buying low and selling high, you don't just go and buy shares of any company that you come across and buy them low and sell them high. You need to identify at least good companies, companies that have solid fundamentals in terms of profitability, they have less debt, they have a competitive advantage. Those are some of the qualities of a good company. But then you have to at least wait for the company to be hit by some negative news that will affect the share price of that company, such that the share price, it crashes and fall, from their all-time highs or wherever they were trading, and then it drops, significantly by 25 or 50%, then that's when now you start doing your research and find out what is it that causes that company to decline. Then you dive deep to those news and read about them and understand them. So the news, preferably for me, I want the news to be such that they don't affect the long-term profitability of the company, and also they don't affect the long-term competitive advantage of the company. Then now I will be confident that these news are just a temporary setback for the company, but over a long term, the company will recover from this and the share price will also recover from this. So these are the kind of the news that I assess, and then these are the companies that I am always searching for, the ones that are declining, affected by these short-term setbacks through this negative news. For example, you saw when I was buying the shares of Ivanhoe Mines, which is one of the largest copper mining producer, and they're still building good mines, around the world. But they are more focusedly in Africa now in terms of operations. They have mines in DRC Congo, which is a copper mine. They also have mines here in South Africa, in Limpopo province, Ivanplats, which is a PGM, So now they're going to be one of the biggest PGM producers. Now, earlier on this year, around May, the company had negative news, such as their operation in DRC Congo, the Kamakakula complex, which is a copper mine. It was affected by a seismic event, kind of like an underground earthquake that happened, and then it affected a certain mining section in their complex. It collapsed, and then a mine was flooded, and that was negative news, of course. A lot of traders who were trading the stock, and also algorithmics that were trading the stock, though they panicked, of course, when those news were released. They sold the shares that they were trading, and then they caused the stock to decline from around 20 Canadian dollar all the way to the lows of around 10 Canadian dollar and 80 cents. So, of course, those were people who were trading the stock, not long-term holders, investors, you understand? But that was an opportunity for you now as a retail investor to start buying low, because the news of the seismic event there, it was just a temporary setback. Of course, the area that is affected, they will lose it, and that will also reduce their reserves and resources. But of course, that doesn't necessarily mean that it will affect the company's long-term profitability and the long-term competitive advantage, because the company is currently busy doing exploration to increase their resources and their reserves. And they also have some assets in the PGM here in South Africa, and they have byproducts such as copper, gold, and zinc into their Ivanplats project. So those news, to me, they were just temporary, because I've seen mining companies that had severe seismic events, such that there was loss of lives involved in gold mines here in South Africa, But they recovered, their share price recovered, and they're still trading high today, because whatever that was lost in that mining section, it was recovered through exploration. So that loss, it can be replaced through exploration. So if you look at this thing over a long term in terms of investing, you're going to benefit if you buy the shares while they're still affected temporarily by those negative news. Over a long term, the share price will recover, because that's what exactly happened with Ivanplats. Currently now it's trading around 15 Canadian dollar, all the way from 10 Canadian dollar and 80 cents. Already I'm up almost 50%, and I just bought the stock around June. Now it's October, and I'm already up over 50%, almost 50%, I mean. So it's the same concept: buy low and then sell high. But I haven't sold my position, I haven't closed my position, and I'm not intending to close it, because Ivanhoe Mines, it's a great company that could potentially pay dividends in future. And I had an opportunity to buy more shares around 10 Canadian dollar and 80 cents. That means now in future I will be earning quite significant dividends with my position when you compare that and convert it into rands. So that's the concept of buying low and selling high. You just want to find a company that is good, that is hit by short-term negative news. And of course, there are traders that are involved into that stock, and also the algorithmics, computers that are involved in terms of trading that stock again. So of course, when that news hits, when they are released, those news hits the market, of course, those machines, the algorithmic machines, they will start selling, and also the traders will start also selling, and then the share price will decline, and also some weak holders in terms of investors will start selling, and then the stock will drop a lot. Then that's where now you'll find that now the share price of the stock is trading far below the intrinsic value, the real value of the company. And then that's where now you chip in and you start accumulating shares, because it's a good company, and you know that this news, they're not going to affect the long-term profitability of the company, or they're not going to affect the long-term competitive advantage of the company, because that's important. If the news affects the long-term profitability of the company, or they affect the long-term competitive advantage of the company, well, then I don't buy the shares in that case. But if the news, they don't affect those two things, well, I do accumulate a lot of shares and then just sit and wait for the share price to recover, because they always do in most cases. So another example that I have with you here, it's Google. Google, earlier this year, it was trading down because of the monopoly charges that they were facing, from the US authorities, because Google actually pays companies such as Samsung, I think even Apple, for using Chrome as their default search engine. So that was regarded as an anti-monopoly practice, and they were charged by US authorities. And that was negative news. A lot of investors feared that Google might lose its competitive advantage if the outcomes of those charges, they are not favoring Google, But of course, even if Google was, the authorities or the court, instructed Google to stop paying Samsung and, like the likes of Apple, to use Chrome as a default search engine, it would have saved Google like billions of dollars, because they are paying billions of dollars to those companies so that they can use Chrome into their devices as a default search engine. That will have saved Google a lot of money, Alphabet a lot of money, because Alphabet owns Google. So it will be great, and people will not stop using Google or Chrome as their search engine, because we don't say go and search that when you want to find something on the internet. We say go and Google it, So we are kind of Google is kind of stuck into our subconscious mind. We are on autopilot using Google as our preferred search engine. So it's going to be difficult for people to just use alternatives instead of Google, So I was like, nah, this company, there's no way that they want to lose competitive advantage. We kind of stuck with it in our subconscious mind. We are on autopilot instead of using, like in terms of using Google as our preferred search engine. So Google will continue being the preferred search engine, and they will save a lot of money for paying those companies for using the Chrome as their default search engine. So they will save money for that, and then I don't see like them losing that long-term competitive advantage. And then I bought the shares. Now today the share price is up, and my position is already up. It's up almost 100%. I think I'm over 80% in terms of the returns or on that position of Google. So you see, that was me buying low, and then I'm not selling. The stock is still high. I bought low based on the news that were released, which affected the share price of Alphabet, which is also known as Google. Alphabet owns Google. So those news affected the share price of Google. Then the share price went all the way down. But then when I analyzed the news that affected the share price, they had nothing to do with affecting the long-term profitability of the company, and also affecting the long-term competitive advantage of the company. So it was a good buy, because Google, it was a good company. So that's how I approach the share investing business. When I buy shares, I look for companies that are trading low, that are destroyed due to short-term news, which cause traders and these algorithms that are trading to sell the stock, and also weak investors, weak holders that sells the stock based on those short-term setback news. Then that provides an opportunity for the stock to be undervalued, to trade below the intrinsic value, and then that's where I chip in and start accumulating the shares of the stock, and then just sit back and wait. And in most cases, these stocks, they recover and they provide returns that are over 50%. So that's how you make money into the stock market, by just buying low and selling high. And if you like the video, please do click the like button and share the video so that it can reach other retail investors out there to understand this concept, so that they can also make money into the stock market and stop losing money. And if you are new to the channel, please do support the channel and subscribe. And if you haven't subscribed to my channel but you're watching my videos and you love the content, please do me a favor and subscribe so that we can grow the channel together. With that being said, I will see you in the next video. Bye guys.